Hello, everyone. Thank you for attending today's webinar about key points for QFII to participate in hedging Chinese stock index futures. So today's session will be mostly covering two parts, and the total time length will be about 1 hour and 15 minutes. And after that, we will have a Q&A session. So if you have any questions, feel free to ask during the theory communication part. So today's webinar will be mostly about how the QFII clients will be participating in hedging Chinese stock index futures. So when we were exploring our markets, it's really hard for us to ignore the needs from the overseas investors, especially the QFII clients, when they're asking about like how can we hedge our position, or better to utilize our margin if we wanted to hedge using Chinese stock index futures. So today's webinar, hopefully it could be a helpful session. So if you have any questions, you can leave in the chat or leave it to the at the very end. So for the first session, we'll have our stock index futures analyst, Wang Mengying, who is from Nanhua Research Institute, will be introducing her part regarding stock index futures hedging from basic to application.
Good afternoon, everyone. My name is Moin. I'm so glad here to have this opportunity to share hedging basics with you. I have divided my talk into three parts. The first part is a brief introduction of China's index future market. Then we will go through hedging basics and its entry-level applications quickly. Finally, our focus will on risk management. Let us start by having a glance at China's four index futures contract specifications. Nowadays, we already have four products of index futures. The most famous one is IF, who is indexed to CSI 300, and it's also the earliest listed product launched in year 2010. The other two, IC and IH, is listed in year 2015. IM is the latest one, who is launched in 2 years ago. The first thing we should note is that the contract multiplier of these four products is different. For IF and IH, each index point of them was RMB 300, while for IC and IM, each index point was 200 RMB. And second, the minimum trading margin now for all the four products is 12% of the contract value. And the trading hour is the same as the spot market. Finally, we should note that the price limit for all of the four contracts is 10% of the settlement price on the previous trading day. And the delivery date and the last trading day is the same. It's all on third Friday of the contract's expiry month. Next, let me show you more information about these four underlying stock index. The left side table shows a sector breakdown of index. As we see, industry is a very important component of all four indexes. It's not weird because around 30% of China's GDP is contributed by industries. Then we can find that CSI 300 and SSE 50 have higher weights in consumer staples and financials, while CSI 500 and CSI 1000 get larger weights in TMT. Next, let's turn our attention to the right side table. It shows the breakdown of free float market cap of index constituted stocks. It's quite clear that the constituted stocks of SSE 50 and CSI 300 have much higher free float market cap than the other two. For example, almost 59% of CSI 1000 constituted stocks free float market cap are smaller than 10 billion. In the end of the first part, it's also necessary to show you the market statistics of index futures market now. Obviously, either from open interest aspect or from trading volume aspect, IM, who indexed to CSI 1000, it's the most active product now. The daily average trading volume of IF is around 90,000, while the IM is over 100,000, which means that all of the four products, the liquidity risk of them, or say liquidity risk of hedging, it's not that obvious in this market. Okay, then let's move on to part 2. Hedging basics and entry-level applications. I will introduce the steps of hedging in this part. First of all, after we choose a suitable index future, we need to calculate the hedge ratio in the next step. The hedge ratio is the future contracts you need to buy or sell to manage the portfolio's exposure. The formula is shown here. As we can see, yeah, it's shown here. We should note that the most important variable is beta. Beta is the coefficient of portfolio and the chosen index. Then how to calculate beta? We think a very simple regression would be enough. We just need regress the return of portfolio on the return of futures, then we will get the beta. The second question is, what if we do not want to eliminate all the systematic risk? We just need to change the formula a little bit. By adding a new variable, I said right here, beta t, which is short for target B. So the new hedge ratio will be calculated like that. Let me give you an example. Suppose investment company ABC holds a portfolio of Chinese stock indexed to CSI 300, and the portfolio worth 100 million. ABC expects the index will fall in the next 3 months and wants to reduce its market exposure by 30%. Let's assuming the portfolio beta depends on CSI 300 is 1.5. So, according to the market statistics, we will choose the September contract of IF as our target. And now the September contract quoted 3,500. By given the multiplier of 300 RMB, the actual value per contract is 1.05 million yuan. So our hedge ratio, by using the formula, is rounded to 43 contracts, which means that ABC needs to sell 43 IF September contracts to change the exposure of the portfolio. And the minimum margin they need is 5.4 million. I want to emphasize that the fund and the cost need to be determined before the transaction is executed. In China's index future market, a suitable reserve amount would be the same as margin, such as in ABC case. We think they need to prepare around 11 million RMB for this hedging program. Based on our past experience, we think double margin would be enough for most of the situations, including when the index price has reached its limit. The third step of hedging is dynamic rebalancing, and we think it's necessary because as time goes by, beta will change so as the hedge ratio. But we don't advise to adjust the position frequently because it will increase cost. We recommend to send a sharehold either based on number of contracts or the beta itself. Then that will be more appropriate. Okay, that's the end of the part 2. The first 2 parts are very simple. Now let's turn our attention to the risk management, which I think is the most important part of today's share. We think there were 3 risks of hedging. They are basis risk, liquidity risk, and hedging ratio risk. I have mentioned the liquidity risk in part 1. According to the trading volume nowadays, we don't think we have a very big liquidity risk in today's China's index future market. And the hedging ratio risk or hedge ratio risk I have mentioned in part 2, so I will not repeat them again. Let's focus on basis risk here. First, basis is the spread between spot price and future price. In most of the time, China's index futures are in backwardation. These 2 charts here are snapshots of index futures trading information on June 21, the day that the June contract will be expired. We can see that the longer time the contracts exist, the higher the basis. So that's a feature of backwardation. Thus, for a long hedge, backwardation is conducive, but for a short hedge, it's not. But most of us who holds stock portfolios, so the frequency of using short hedge is much higher than long hedge. That's why I think we need to know more about the basis in order to find a better time or say a better price to establish our short hedge position. According to the methodology of China's stock index, the index points will fall down naturally when the dividend paid. The chart here on the left side shows the influence of dividend paid in each month of this year. It's obvious that the influence is more significant during May to August, as we can see in the chart, because most of the constituted stocks will pay their dividends in these 4 months. And the table on the right bottom is the influence of this year's dividend payment on each contract. I mean the contract listed on June 21. As we can see, the index points fallen down would be more obvious in IF and IH. The index number will be much larger than the other 2 because the dividend yield of these 2 index is much higher than IC and IM. For example, the dividend or yield of SSE 50 is 2.8%, which is almost double than CSI 1000 index. Besides that, we think a more important usage of basis is in market timing. In my opinion, basis is a kind of price, or say a real price of future, because it represents the difference between spot and the future, which means it contains the market sentiment in the future market. And this information we cannot observe in the spot market, so it's unique And that's why I think we can use basis in market timing and believe it will be effective. As we know that since every time we have 4 basis data for a certain product, but for market timing, we only need 1 indicator. So we compress 4 basis data into 1 by using volume weighted average technique. Here's the result. I show it in a seasonality chart in order to examine if the seasonal feature has disappeared or say has become insignificant. As we can see here, the peak and the valley of the data is still very obvious, but the seasonal feature has become insignificant. That's what I want to see. Which means that we can use this volume weighted average basis as an indicator from market sentiment. Now let's put this data with trading volume together and in a time series chart. We can see as we put the so-called price and the trading volume data together, we can use technical analysis now. We use technical analysis to find the so-called vital market timing point. In technical analysis, when price and volume move in the same direction, people think the trend will continue. Well, when the price and volume move in a different direction or say in an opposite direction, it always means the trend will be reversed. Thus, when we observe this chart, we want to find the moment when the price and the volume are moving in a different direction, because that will be a vital market timing point. For example, in the beginning of this year's, in the beginning of February this year, CSI 300 has declined over 5% in several trading days. Most of the investors were afraid of more falling down in the following trading days. But if we observe this chart, you can see the price and the volume relationship shows that the market has priced in enough fear, which means the trend has a high probability to reverse. So if we want to hedge in those days, long hedge would be more suitable than short hedge, or that will be a good time to close our short hedge position. If you are familiar with the trend of CSI 100, you will know that after the beginning of the February, the CSI 300 has rebounded a lot. So it also shows that our indication is very effective. Finally, let me show you 2 case studies. The first case is a short hedge position designed to avoid the annual risk during Spring Festival. And this case was happened in last year. As we can see here, we established the position on January 18. And the contract we choose that time was March contract. And the opening price is 4170.62. And after the Spring Festival on 8th of February, we closed the position. The closing price is 4095.34. So the profit in future market is about 75.28 points. In the same time, in the spot market, the CSI 300 fell 54.17 points. It's obvious that the future side gains more profit than the loss of the spot. The difference is due to the basis change. As we can see in the chart, the March contract has much higher premium rate on January 18 than that on February 8. So this case tells us that when we conduct a short hedge transaction, try our best to find the highest premium rate contract. Also, we need to take liquidity into consideration. The second case is a short hedge by using Nanhua market timing signals. Nanhua market timing system is designed to capture the best timing for trade. The system result is very simple. The green dot signal means the market sentiment is cool. In contrast, red dot signal indicates the market is overheating. The chart on the bottom left shows the timing signal during January to June in the last year. And our client established its hedging position according to these signals. We recommend them to sell May contract on April 6th and close the position on May 10. We choose May contract because at that time it has the highest premium rate and the liquidity is enough for their transaction. The result here shows that they gain additional 2 more index points in the future market, which is very close to the change of basis of May contracts. And our signal successfully indicates the price movement at that time. So to put it simply, we think market timing is very important because a correct market timing will provide a better price for hedging. So basis risk can be well managed by choosing a good market timing point. That's all of today's share, and thank you for your attention.
All right, thanks for sharing from Mengyi, and I think that's really both professional and also very helpful for our attendee for today. So for the next part will be mostly on me introducing about key points for QFII to participate in hedging Chinese stock index futures. So yeah, thank you guys for listening today. So my parts will be mostly divided into 4 parts. So at the very first, it's about the China's derivatives market. So mostly under this part will be about background introduction for China's derivatives market since 2018. So we can see on the time chart at the very left on the 2018 is where Shanghai INE and the DCE and the ZCE, both of these 3 signature Chinese exchanges launched their Hasha commodities. So INE has its crude oil futures, and also DCE has its iron ore futures, and DCE has its PTA. So all these 3 products. So all these 3 products are very helpful for the clients to understand Okay. So on the second part, it's the Chinese futures market trend. So yeah, going back a little, sorry for the point problem of sharing the screen. And on in 2019, INE has launched this TSR20 futures, where it's so all the rubber players in the global will be mostly watching the TSR20 are hedging with Malaysian products also. And so following that in 2021 and 2022. INE and DCE have launched a lot of like soybeans, so mostly all the agricultural related products to the rest of the world for them to join China's derivatives trading. And until last year, INE launched its the Euro SCFIS futures, which is pretty hot at the beginning. And also, Zhengzhou ZCE launched its rapeseed oil futures and its peanut kernel futures, which is also kind of peanut kernel, I would call it like unique to the Chinese market. And following by that, it's the Chinese futures market trends. It's the trading volume and turnover rate of the Chinese futures market since 2016 to 2024. So we can see at the diagram on the blue box are the volume in 100 million lots, and also the red line will be the turnover rate. So we can see in 2021 and 2023 are the both of the peak times for the past, I would say like a decade or so in terms of the trading volume. So I think because like during these 2 years, the market volatility is pretty hot, and there's a lot of like not only domestic players but also the global traders have found really good opportunities in this market. So these 2 years, we observed a significant increase in terms of the transaction status. And this is the chart which shows where we are among the global exchanges. So this is the top 10 exchanges by the trading volume of the futures and options in 2023. So we can see on the top 10 ranking, we cannot really to ignore the India market is really hot. So we can see number one, number four, the NSE of India and also the Bombay Stock Exchange have really high year-on-year growth. So India market, and also following that, we can see Brazil B3 on the ranking number two, and also the like the old traditional very top and mature market on the CME, CBOE, ICE, Nasdaq are the global mostly on the US and EU region. And for the number seven, nine, and 10, it's the ZC, DC, and the Sheffield are the three Chinese exchanges are among the top 10 of the exchanges globally. So I guess the message here we were trying to tell the global investors is here that Chinese futures market is a growing and developing market. We can really trying to deliver to the rest of the world for them to try and for them to see the uniqueness here in China. And in terms of the increasing of the overseas intermediaries, so we have like 150 domestic futures firm here in mainland China domestically. So this is like the majority part of the intermediaries here in China. And also for the like in terms of in the middle of the Asia Pacific area, we have like the Hong Kong and Singapore are having a decent number of OIs. So Hong Kong has 43 and the Singapore has 14. While we do have an also seven in Korea and two in Japan, another one in Thailand. And in the EU region, UK is the like the center in the EU region where we mostly find our intentions in the UK region. And also we have Netherlands, Germany, Switzerland, and France. And there's one place we really trying to focus on recently is the UAE. Dubai and Jakarta is like the best place to cover the trading time zone, not only for the Asia Pacific area and also the UK and the US region. So it's like somewhere in between. It's like a really suitable for like the intermediaries to run in the UAE, Dubai, and the Jakarta and Abu Dhabi. So these are the three top places we wanted to really to develop in the future. And this is the Chinese futures and options chart for the OIs and the QFII updated in last November. So under this chart, we can see like what if the clients are invested into Chinese market via QFII scheme or under the regular internationalized contract method, so you can see the product scope difference. So if you have any specific products you want to trade in. So for example, under Sheffield, Shanghai Futures Exchange. So if you wanted to trade silver futures, then I guess the only method or the only proposal we can give you is to invest via the QFII method. So that will be the only possible way to trade silver here. And also together with the like the aluminum, the zinc, gold, and copper, regular copper. I mean, so these three are the like the uniqueness to the QFII. But for other product like the crude oil, you can both invest in trading into this product by the internationalized contract way or the QFII way. So generally, I think in terms of the trading scope, QFII does have a wider scope than the internationalized contract way. So that's also the reason why we're seeing more and more QFII clients are entering this market rather than the general internationalized contracts. So feel free to take a snapshot or take a screenshot for the chart, and we can also share the slides after this webinar. So and under part two, so under this part will be mostly about the pathway to participate in trading China. So it's mostly like correlated to the last slides that where we introduced about the different trading scope between QFII and internalized contracts. So under this pathway, so if you are an offshore investor, you can choose, like right in the middle, you can choose to be a QFII scheme subscriber, or you can choose to be underneath an existing OI, as in like an underlying clients of an OI to trade through the OI and the onshore broker, and then to the internationalized contracts. Or you can choose to subscribe to a existing QFII fund. So simply you need to go to a existing QFII quota holder. So for example, our underlying Hong Kong H&H Asset Management Company who holds the QFII license. So they can provide you the QFII scheme service provider. So simply you will go to them and they will create a designated QFII project for you, and you can subscribe that fund, and the fund will be trading through the onshore broker, which will be Nanhua Futures here in this case. And under that scheme, you can trade those 23 futures and 16 options for commodity futures, and the financial futures, which has 4 futures and 3 options for hedging only, which is mostly we're about to cover today. So financial futures. And rather, other than that, you can also invest in a mutual fund and private fund, and also interbank bond market. And also, you can choose to invest into the security broker for Chinese regular bonds and stocks through the QFII scheme. And underneath that, you can see offshore investor. You have option number 3. You can choose to go to directly trade through an offshore broker through China Connect or TRS for China stocks or China futures. So TRS will be mostly like a swap. You can we usually give clients for a general proposal to see how we can assist you in the revenue swap during the TRS plan. And at the very last will be the most traditional, I would call it like most traditional or the most long-term partnership way. It's the WOFI. So to set up a WOFI here in China, and or like a joint venture company here in China will have like everything included into your trading scope, but sadly, that will take like more or sophisticated rather than just open a QFII account or rather than just simply go to an OI to open a trading account. So depends on client's needs. We can give you like customized trading solutions, and if you want a short term to do it the right way, or we can give you solutions for example, setting up a WOFI and how we can assist you about doing that in domestic China to achieve the long-term goal. And shifting on to part three, it's mostly about application and calculation for index hedging. And so this part, stock index futures hedging and the quota application. Under this, so hedging and arbitraging quotas are divided into product quotas and the near delivery month contract quotas. Under application, we will mostly introducing you with application requirements and its materials and also its process. So first is the applicational requirements. So the first will be requiring you to have an existing or a already been opened stock hedging account opening at the bank. And also, so the second will be you need to provide a valuation report which shows you do have a certain level of scaled assets. And in terms of its materials, so the documentation must be stamped here. So following by item 1 to 5. So the first will be the security and futures business operation permit will be issued by your local regulators. And the second will be the confirmation of securities account opening, which ensures that you have all the Shanghai and the Shenzhen accounts. So the stock exchange account, if margin accounts are involved also, you need to provide that proof also. So number 3, you need to provide a most recent valuation report for the products. So it is to confirm that the valuation report shows a significant scale of the assets, as I said. So this is to simply provide to the regulators to see like how big you are and how much asset you own to prove that you are, I would call it, mature enough to enter in this market with index hedging. So number 4, it will be a hedging plan for the stock index futures and options. So under this one, I will call it, it's really a flexible written plan you need to submit to the exchange. So this one I will go into that in the later part to see how we can assist you in like composing a hedging plan for this. And number 5 will be simply a screenshot for the CSRC approval filing. And one more form to be completed, and then we can always assist you in that. It's the hedging and arbitraging quota application form. It's a pretty simple and straightforward to state who you are, and we can see the form. Yeah, so this will be simply how the form looks like, and it's just simply on the basic information to say who you are and like your contact person, and also how much like will be the physical cash account number you have, and also how much quantity or how much lots you wanted to apply for the quota simply. Going back a little, so this is the number 3 applicational steps. So the process takes about 3 to 5 days, depends on like how like when the exchange will approve that. But basically, the applicational process will be the Nanhua provides the application form and reference plans to the clients, and then the clients will give back to the aforementioned documents in the electronic format, and we confirm. Then you can mail the original documents to us, and then we review and submit to the exchange. And then once the exchange approves that, we can give feedback to the clients simultaneously, and we can start then sending notes to the clients for clients to get ready for trading. So this has been covered, and also this will be the requirement of the hedging trading plan, as I said. So basically, the hedging trading plan includes like all these 6 components here. So you'll be stating your trading strategies and your necessity and the reasonableness of the quota for managing risk exposure. And also the correlation measurement between futures and the hedging target assets, including your calculation method, like how it comes to you want to apply this amount of the quota. And also number four, the effectiveness of hedging, and also the introduction of the investment team. And then number six is the investment substitution needs and the scale of the relevant asset to be substituted, and also the entire trading plan. So I think the general idea we're here to trying to convey, or I mean the clients here to trying to convey to the exchange is that basically who you are and why you wanted to apply for the quota and how you're gonna do it once you get the quota. So basically, if you have like all these three major topics or major components under your trading plan, I think the exchange will give it a go. So we have a lot of the application going through time by time, and we often got asked by the clients, is there any like exchange approved templates or something you can give us for the trading plan to compose? I think we can like the most we can do is to tell you to write your own plan. The idea behind this, the rationale behind this is simply we wanted to come up with like the different trading plan for different every clients by simply offering you a like straightforward templates to fill in A B C D and to give you that. So in order for the exchange to get to know who you really are and what you really want to do, and it really does to help the exchange to expedite it and also give you a detailed overview of how things should be done, basically. And in terms of the quota expiration and renewal, so the product quota will be valid for 12 consecutive months from the next trading day after the approval date. So if any non-futures members and the clients still need to use the quota after the expiration, they need to submit a new application to the exchange within like 10 trading days prior to the expiration date. So you I guess you have to like thinking ahead instead of like after the quota is actually expired, then you think, hey, I really need to use it. Then it will be like more than just filing a new application form to the exchange. So if a new quota is not applied for within the specific period, hedging the arbitraging position should be closed before the expiration of such period. So which states, if you don't own the quota anymore, you need to close the position accordingly, or it could violate the exchange rules. So part four, it will be mostly about operational rules, so index futures hedging. So under this, so first we're going to go through simply about three major abnormal trading behaviors. So first will be the mismatch between futures and spot prices. So by hedging transactions, the contract value or the risk value of buy hedging position held by the clients must not exceed the relevant asset or risk value of the plan substitution. So the investment plan and the asset scale should be clearly specific in the hedging plan. So that's why we wanted to, go through deeply when we are trying to compose a hedging plan and trying to submit to the exchange. And for sell hedging transactions, for all types of stock index futures and stock index options, the total contract value of sell hedging positions held by the clients must not exceed 1.1 times the market value. So it does give you a little bit cushion. So 1.1 times the market value of the stock index constituent stock ETFs and the law funds of all type. So and also the stock index option selling hedging quota can be used for selling call option contract value and buying put option contract. The same spot asset can be used to apply for both stock index futures hedging quotas and the stock index option hedging quotas. So however, spot assets already used for stock index futures hedging transaction cannot be used for stock index options hedging. So these two cannot be cannot be stacked simultaneously. So these are the two separate and divided apart. So how to understand that the value of the sold hedging position in stock index futures and the stock index options shall not exceed 1.1 time of the market value of assets. So this will be like the breakdown explanation of the aforementioned part. So in principle, the value of the sold hedging position in stock index futures and index options shall not exceed the sum of the market value. So instead of be 1.1 time, it should be like the like 100 level, 100% level. So however, there are certain object reasons that may cause slight deviations between the values of the stock index futures, options, and the spot assets, such as difference in settlement prices and also the calculation method of stocks. So there could be like a 0.1 times cushion in between, and then we put that to the general calculation to avoid any conflicts in calculation. So generally. And about the remedial measure of mismatch. So when you hit the first time, so it is only required for a timely adjustment, and maybe the exchange will give you like an oral warning, or you need to put a status report and submit to the exchange. But if you do the second time, so the penalty measure restricted of opening new position, and it will be lasting for 5 consecutive trading days. So you cannot be trading, cannot be actually opening new positions for an entire week, obviously. And if you do it a third time, and the penalty measure will be lifted to a whole month. So for this entire month, you can only close in your existing position without opening any new position to trade. And the second one, exceeding the prescribed position limit and the remedial measures. So you cannot exceeding the prescribed position limit. So it requires no single directional position in the futures and option product shall exceed in the hedging or arbitraging limit approved for that direction. So simply like how many you got approved, and this is the number you can trade within. And three is the hedging, frequent trading, and the remedial measures. So the volume of buy to open and sell to open transaction in hedging trades per calendar week must not exceed twice of the buy limit, and the volume of sell to open and buy to open transaction must not exceed twice of the sell limit. So this is this is like the general measurement for hedging frequent trading. So you need to obey for the exchange rules also. So in terms of the scope of the assets, we often gotta ask, so what would be the scope of assets corresponding to the hedging of the sold position in stock index futures and options? So basically, it's chosen in between of the CSR 800 index and all A-share stock ETFs and law funds listed on the Shanghai and the Shenzhen Stock Exchange. So for a specific list of eligible stock ETFs and law funds, we have in next slides to showing you like where you can search, where you can find the correct official website for the both Shanghai and the Shenzhen stock exchanges. So these the picture, the snippet at the bottom will be showing you the 300 level and 50 and Shanghai 50, and also the CSI 500. So these are the three major components where are the stocks are coming from. And this is the spot asset scope where it shows the SSE. You can refer to the SSE website or the SZSE, which will be the Shenzhen Stock Exchange, the law funds list. You can refer to that to see will be the underlying assets of the trading scope. So this will be everything I covered for today. So feel free to contact us. So we are Nanhua Futures based in China, Hangzhou. So this is where our headquarters is. We do have our Hong Kong, Singapore, Chicago, and London branch located accordingly in different cities. And you can simply contact us via the department email or scan the QR code right in the screen to add me for any further questions. So that's all for my slides. So if you have any questions for any contents of today's webinar, feel free to share in the chat or leave a message, and we can share all the slides for today. Thank you for attending.